All right. Lots of ground to cover today. We're talking about capital structure. So again, here's the idea. Towards the end of, the last lecture that we had, we said that, look, the question of capital structure is, how do we change the right-hand side of the balance sheet to create any value? We said under very restrictive assumptions, capital structure does not matter. Specifically, Modigliani Miller in their proposition basically said, their first proposition was that value of the levered firm is the same as the value of the unlevered firm. In other words, whether you are levered, whether you're unlevered, doesn't matter. The value of the firm is going to be unchanged. They made a bunch of assumptions. One of them was that we're living in a world with zero corporate taxes, no agency costs. So I'm going to talk about relaxing those assumptions in a minute. But proposition number one, which is this, the value of the levered firm equals the value of the unlevered firm, that is the same thing as saying that WACC remains constant. In other words, the cost of capital doesn't change. And so again, this graph sort of goes about explaining that quite nicely. It says that, look, if you have no leverage and so R naught represents your cost of capital, you can refer to R naught as your cost of unlevered equity, because as you can see, this is the point at which you have no leverage, so all your equity is unlevered. So this is the situation where the firm is exactly unlevered. So if this is your cost of capital or cost of unlevered equity at this point, as you will start taking on more and more leverage and start borrowing at the cost of debt, equity holders are going to start wanting more and more in return as a result, because equity is becoming riskier. However, if you'll start taking a weighted average of cost of debt and cost of equity, what's going to end up happening is that your WACC will still remain the same. So because the WACC will remain the same, the value of the firm is going to remain unchanged as well. And their main point, again, was this, that because the right-hand side of the balance sheet is merely a distribution of value does not influence the generation of value. So generation of value happens on the left side. Capital structure simply redistributes that value across debt holders and equity holders. So that was their main idea. We covered this. I wanted to illustrate this using an example. So consider a very simple example where you have an all-equity firm, and let's suppose that it has a beta of 1. Okay? So because it's an all-equity firm, this beta you can think of as the beta. So this is the beta of equity. But because it's an unlevered firm, this is also the firm's asset beta or unlevered beta. Okay? Now, the risk-free rate is 5%, and let's assume that this is the cost of debt as well. So this is a somewhat simplistic assumption, and again, it doesn't matter that much, but basically what I'm saying that the risk-free rate and the cost of debt, let's suppose they're the same, which is 5%. Which basically means that I am explicitly assuming that the beta of debt is 0. Right? So debt is risk-free. Okay? All right, so I'm assuming that the debt beta is 0, so that you can borrow at the risk-free rate. The market risk premium is 6%, and let's suppose taxes are 0. Okay? Now, in this very simple situation, if I asked you to calculate the cost of equity, what would you do? And simply over here you say, well, the cost of equity is going to be the risk-free rate, which is 5%, plus the equity beta, which is 1 in this case, into 6%, which is the market risk premium. So you'll say it's 11%. Are you with me on this? And because this is the cost of equity that exists when the firm is unlevered, it's an all-equity firm, we can also call this guy the cost of unlevered equity. In fact, I can also call this my R naught. R naught is the specific cost of equity that exists when the firm has no leverage. Okay, so it's a cost of unlevered equity. So far, so good? It's kind of important to drive home the point. it's the next part which I want you to sort of see as to how this works, and I want you to appreciate how this is consistent with Modigliani-Miller's proposition. So now let's suppose the firm moves to debt to equity ratio of 0.5. What would be the firm's weighted average cost of capital now? How would you do this? Right, so firm was all equity, and now it's moving to a debt to equity ratio of 0.5. What would you do? How would you go about calculating the cost of capital? Where we know that, and again maybe, right, so we know that WACC in this world where there's no taxes, it's B over B plus S into the cost of debt. There are no taxes, so I don't need to multiply by 1 minus t yet. And then I have S over B plus S into the cost of equity, right? So this is my WACC. So what should I do? What is the one thing that will have to change? Yes, Ted?
I just want to so the B over S, are you saying that's the same as B over B?
No, actually it's not. B over S is the debt to equity ratio, and B over B plus S is the debt to value ratio. They're two different things.
Okay.
So you will need to move from this guy to this guy.
Okay, so it's 1 over 2 and then it's 3 parts.
Well, yes, exactly. So when you're given the debt to equity ratio is 0.5, you need to move from this guy to this guy. So this is what I recommend. Use the balance sheet identity. So we know that B plus S, this is the total sum, B plus S, which appears in the denominator. B over S equals to 0.5 means that you're basically saying that B over S is basically 0.5 over 1, isn't it? Right? When you say that the debt to equity ratio is 0.5, that's like saying that if debt is half, then S is 1. Right? So if they're in that proportion. So then B plus S would basically be equal to 0.5 plus 1, which is equal to 1.5. Right? The total has to be that. So now B over B plus S then is, if debt is 0.5 and the sum of B plus S is 1.5, this is 0.5 over 1.5, or basically 1/3, like you said, right? So this is 1/3. And the remainder is equity. So these are the weights then. The weights are 0.5 over 1.5 and then 1 over 1.5. Right? These are the weights. Does that make sense? Right? All I did was converted debt to equity into a debt ratio. So the weights are there. What else would I do? What are the two other things that I need here? Yes.
Well, I guess you technically have to unlever beta now.
Fortunately, you don't have to unlever it because as it is, there is no leverage. So you just need to figure out what the new one would be, right? So you can go about saying that, okay, the cost of debt, this is 5%. This is given, but you cannot, for cost of equity, you cannot use the initial cost of equity of 11% because this 11% existed when you had no leverage. So you could do one of two things. The first approach would be that you say, look, equity beta is 1 plus B over S into the asset beta. Right? We know this from the relationship between equity beta and asset beta. And here we know that our asset beta was 1. So our equity beta is going to be 1 plus 0.5 into 1, which is equal to 1.5. And with this 1.5, if you now go and plug this 1.5 into CAPM, right? So instead, maybe I'll use a different color here, right? So now if you instead of this 1, if you put 1.5 here, this 11% will change to 14%. Right, so the new cost of equity that's going to exist will be 14%. Right, so 1.5 into 6, that's 9, plus the 5%, so 14%. And I'm saying that basically you should go and plug 14% over here. But notice that when you will solve this, when you do 1/3 of 5%, and 2/3 of 14%, you know what the answer is going to come out to? Marty Glennon Miller actually said so, and we're going to find out that it's going to come out to exactly 11%, which is exactly what Marty Glennon Miller is saying, that even as you take on debt, your cost of equity went up. Yes, that's true. But if you take a weighted average of this 5% and this 14%, your cost of capital is still 11%, which is the cost of capital that existed when you had no debt at all, which was your unlevered cost of equity right here. And that's precisely what this graph is saying as well. You were at 11% in R0, and as you move to 1/3 leverage, you will remain at 11%. So value of the levered firm and value of the unlevered firm is the same thing. Right? So I'm just trying to explain to you how mathematically this is coming about. Now, again, we're in a world where debt is riskless, which was, again, what Marty Glennon Miller assumed. And we're in a world where there's zero taxes, which is, again, one of the assumptions. When these things change, well, the results may not hold like this exactly. In fact, that's the next thing that I want to do. But I wanted to numerically explain to you what's happening. Are you with me here? Yeah. So what if we relax the assumption that corporate taxes are zero? So what if we say that they're non-zero? What happens then? What is the one thing that will change now? Alex, any thoughts?
I was going to say cost of debt, but I don't think it's correct.
What about the cost of debt?
Well, I mean, I'm not entirely so like
Sure,
if your tax structure is going to change, right? So if you're not initially paying taxes, the more you borrow. But are you being borrowed? I'm sorry, are you being charged debt on like? I don't know. Like, are you paying taxes on government debt?
So here the perspective is that of a corporation. We can talk about government debt as well, but what makes debt and equities different is that when you pay interest on debt, you're able to reduce your taxable income because interest is tax deductible, right? So because of that, you will have a preference towards debt. Right, because what's going to happen is that if you have a project that you're looking to fund, okay, if you took money from an equity holder, that will not reduce your taxable income. But if you took money from a debt holder to fund that project, all the interest that you're paying to that debt holder, that's going to be tax deductible, which is going to reduce your taxable income and therefore save you money on taxes. Right. So one of the reasons why people say, hey, you know what, why are you paying or wasting so much money renting that house? Why don't you just buy it? One of the motivations being that all the mortgage interest that you'll be paying, at least that'll be tax deductible. That's one of the motivations that people have towards buying versus renting a house. Same thing goes over here. So when corporate taxes are non-zero, what that does is that all of a sudden it makes capital structure relevant. Why? Because interest expense is tax deductible. Now, mind you, interest expense is not tax deductible everywhere in the world, right? There are European countries where interest expense is not tax deductible, some Asian countries where interest expense is not tax deductible, but at least here in the US, interest expense is tax deductible, which means that interest will save you money on taxes. It's like this. Let's suppose that you call Domino's. Okay, and Alex and Jacob maybe say, you know what, we should maybe partner up and get the pizza. You call Domino's and the guy says, look, we're running a special today. If your name isn't Jacob, we keep 1/4 of the slice for ourselves. So you just get 3/4 of it. Now that's like the government saying that whatever you are ordering, we're going to keep our slice of the pie. Okay. Now, if your name is Jacob, however, then, we won't keep that slice. We'll keep maybe just 1/8 of a slice. So if Alex and Jacob were sort of partnering up, what do you think would happen? What do you think they would conclude we should do? Alex would probably say to Jacob,
I was just gonna say they should put the business in Jacob's name.
Well, yeah, exactly, right? Exactly, right? Alice will tell to Jacob, look, Jacob, why don't you make the call, make the full payment. This way, we get more of the pizza for ourselves, and then we can distribute among ourselves, right? Yeah, makes sense? That's exactly what we're saying. All of a sudden, here, who's ordering the pizza and who's paying for the pizza matters, right? Because you get to keep more of it, and that's exactly Modigliani Miller's point. Because one party is getting a preferential treatment in terms of taxes, which is debt holders, here debt funding matters. So basically, if you look at it from a pie perspective, again, think of this as a pie. When there are non-zero taxes, if this is what the firm is generating as a whole, in an all equity firm, you know, this S is what you get to keep as an equity holder, and all of this portion of the pie will end up going to the government, right, in the form of taxes. But if you're a levered firm, for the same pie, if some of it is funded with equity and some of it is with debt, what debt helps do is that it reduces the portion of the pie that goes to the government. So the value of the levered firm is more than the value of the unlevered firm because, and here's the punchline, the sum of B plus S, is more than S by itself on the left-hand side. Value of the levered firm is B plus S over here. Value of the unlevered firm is just S over here. Levered firm is more valuable because the sum of B plus S is more than S. What is very, very important for you to realize is this. This sphere and this sphere as a whole, they're of the same size. The assets that are in place of the firm and the cash flow and the value they're generating is the same. The size of the pie is the same. What leverage helps do is that it helps you keep more slice of the pie. It is in that sense that the levered firm is more valuable. But the size of the pie remains the same. What taxes really do is that they just include one other claimant on the cash flows, which is the government. Government says, hey, where's our cut? And they get to keep less of it when there's leverage. So that's what's happening. Does that make sense? Right? So this is happening because interest expense is tax deductible. That's the key. So Modigliani and Miller then specifically showed under their assumptions that the value of the levered firm will not just be equal to the value of the unlevered firm, it will also be equal to T times B, where T is the corporate tax rate, and B is the amount of debt that the firm is maintaining. Where so B is, they assumed, so here was their assumption, and this is not a restrictive assumption, we can relax that as well, but say the B here is the perpetual debt that the firm is maintaining. So this is very, very, very important. I want you to pay attention because this will actually, the calculation that I'm about to do, this is going to appear in one form or another later on as well. So here's what they said, Modigliani and Miller. They said, look, let's assume that the firm is partly funding its operations with debt. And let's suppose the amount of debt that the firm is keeping is B. So B is perpetual. So think about B as maybe like $1 million. In other words, the firm has borrowed $1 million worth of debt, and now it's going to keep it at that level perpetually. It's not going to retire the principal at all. Let's suppose. Of course, not as realistic as most situations, but drives from the point, and turns out that even if you relax the assumption that the debt is not perpetual, their point will still come across just fine. But let's assume that the debt is perpetual. Let's further assume that the cost of debt is RB. So this is the cost of debt. All right, so cost of debt. In other words, you can think of this as the interest rate that you're paying or the coupon rate that you're paying on that perpetual debt or bond. Okay. So now here's the thing. If I ask you what is the yearly interest expense that this firm is going to be paying? What is the yearly interest expense that this firm is going to be paying? What will you say? based on the information that I've given you. If you've borrowed 1 million and the interest rate that you're paying is RB, then the interest expense will simply be B times RB, yeah. So RB multiplied by B. So this is my interest expense. This is what and because the debt is perpetual, this will happen every year. Every year I'll be paying this. Yes? Here's the thing. Because interest expense is tax deductible, this means that my interest, this is called interest tax shield. Interest tax shield. In other words, how much will I be saving in taxes? How much will I be shielding myself from taxes because of my interest expense? Well, if RB times B is my interest expense, the amount of taxes that I will save will be T times RB times B. Right? So let's suppose that my interest expense came out to like 100,000. Let's suppose. Because this guy was like 10%. Let's suppose. If my interest expense is 100,000, what's going to happen? My taxable income is going to go down by 100,000, which means that I will owe 21% of, if tax rate is 21%, I will basically owe T times RB times B less in taxes because my taxable income dropped by that amount. Are you with me here? Right? So RB times B is my interest expense, and this is how much I'm going to save in taxes. This is extremely important. Are you with me here? This is my tax shield. Because the debt is perpetual, this means that every year, T times RB times B, this is the amount that I will save at the end of year 1, at the end of year 2, at the end of year 3, so on and so forth. So if somebody asks me, what is the present value of your interest tax shields? ITS's interest tax shields. What is the present value of these interest tax shields? What is it that you're saving in present value terms? The nice thing is that this looks like this cash flow stream, this looks like it's going on forever or perpetually. So this looks like a perpetuity, right? Because it's the same amount forever. You say, okay, just take the constant cash flow and divide by the discount rate. And here, the appropriate cost of debt is RB. So what you're going to do, you're going to take your constant cash flow, which is T times RB times B, and divide by the cost of debt, which is RB, which is your discount rate, this cost of debt. RB cancels out with this guy. And so what you're left with is T times B. The point that I was trying to make in all of this is that this T times B is basically reflecting the present value of your interest tax shields. Or put differently, T times B is the present value of all the money that you're going to save in taxes because of your interest expense. Okay? And that is the amount by which the value of the levered firm will be higher. And that is exactly what Modigliani Miller basically said. They said that, look, value of the levered firm is equal to the value of the unlevered firm. And what debt does is that it allows you to save in taxes on the interest expense. The present value of all the money that you save in taxes turns out that in this simple situation where you have a constant amount of debt forever, that present value equates to this. So T times B is very specific to the assumption of perpetual debt, but you must realize that the general result that Modigliani and Miller are saying is the value of the levered firm is value of the unlevered firm plus the present value of the interest tax shields. This is the general results. General result, right? In general, this is the amount that you're saving in taxes because of your interest expense, and therefore this is what how much value leverage is bringing. Yes, Alex.
I don't have a question on any of this. I was just gonna ask, what would then be like the disadvantage of issuing equity, like to finance the firm? You know what I'm saying? Like, why would you ever issue equity if being debt financed?
Oh, good. Exactly. Excellent, right? So Alex is saying, well, if that's the case, fund everything with debt, right? If that's the case, why would ever Alex order the pizza, right? Jacob always orders, right? Absolutely, you're absolutely right. But in the real world, we don't see that, right? So there's something that must be missing in this picture. It turns out there is, because what we are doing is peeling off the onion step at a time. We just relaxed one assumption, which is, what if they're non-zero taxes? We're still holding all other assumptions the same, such as there are no financial distress costs. But as soon as we relax that assumption, all of a sudden it's like maybe too much debt can have downside as well. So there is a trade-off, right? So we'll do one step at a time, right? So all other assumptions are true, but we're you're just relaxing one assumption. So you're absolutely right. You're absolutely right. In fact, graphically, what this means is this: is that as you will start taking, so again, take the same graph, as you will start taking on more and more leverage, your equity holders will want something higher, of course, because debt is going up. But you can show actually that the rate of return that equity holders are going to want will not be as high when taxes were non-zero, when taxes were zero. Right, so this is the Modigliani and Miller proposition 2 that existed when there was zero taxes. In the presence of taxes, it is still true that as the firm takes on more and more leverage, equity holders require a high return, but it's not as high as previously. So you have this 1 minus t expression appearing right over here. So that dampens this increase in required equity return. And as a result, this is the key, weighted average cost of capital consistently falls. Your cost of capital is consistently falling. And the reason is, of course, now because you have this in your 1 minus t appearing here in this formula now. So you might recall that previously, I had asked you to sort of think of two graphs simultaneously. If you're measuring debt to equity over here, and if you're measuring cost of capital here, and then if you're measuring debt to equity here and firm value here, I said that both graphs go hand in hand. In the absence of taxes, so when taxes were zero, we said that here is the cost of capital R0, and then as you take on more and more debt, WACC doesn't change. So WACC and R0 are the same, which basically meant that if this is the value of the unlevered firm, which is the value that exists with zero debt, as the firm will take on more and more leverage, value of the levered firm will remain the same. Right, so this is in the presence of zero taxes. What I'm saying to you now is that, let me use a different graph. The moment you say taxes are non-zero, what we're saying here is that weighted average cost of capital is consistently falling, like you said, because you would always prefer more debt compared to less. And as a result, the value of the levered firm is therefore consistently rising. Specifically, value of the levered firm is starting with value of the unlevered, and then it's equal to T times B, where T times B is this added present value of the interest tax shield. So this line, WACC going down, is the same thing as value going up. They're two sides of the same coin. WACC remains the same, value remains the same, WACC goes down, value goes up, WACC goes up, value goes down. They're two sides of the exact same coin, okay? This is very important for you to appreciate. I'm just saying the same thing. Are you with me here? So I just showed you how Modigliani and Miller proposition number 2 changes a little bit. This is how you would calculate the cost of equity. Just the formula changes a little bit here. Now, and so this was the graph. You must be very, very comfortable calculating present value of interest tax shields. I just showed you present value of interest tax shields requires two things. How much you're going to save in taxes because of interest expense. And if you know what that amount is going to be in year 1, year 2, year 3, just discount them back at the cost of debt. Let me try and give you another situation where you need to calculate this. So what if debt is neither constant nor perpetual? Then how do you calculate the present value of tax shields? Right? So in the Modigliani-Miller world, things were convenient because you had the same amount of debt forever. What if that's not the case? So let me give you an example. So let's suppose that there's this company called the Maxwell Company. Okay? And it has $1 million in debt with a coupon rate of 8%. So this is how much they're paying in tax, in interest rate. If debt matures in 2 years, okay, so this is what tells you that the debt is not perpetual. It matures in 2 years. And the cost of debt is 10%. So think of this like the yield on the bonds. What is the present value of the tax shields if the corporate tax rate is 35%? Assume that, and this is important, assume that the debt is amortized in equal installments over the 2 years. Equal installments over the 2 years. Okay, so what I'm going to try and show you is this. There's this firm which has $1 million in debt. It wants to pay off the entire 1 million in a span of 2 years. Okay, and wants to do that by amortizing it in 2 equal payments. So debt will retire. It's neither constant nor perpetual. It's definitely not perpetual, and the fact that you're going to pay off in 2 equal installments means that it's going to be, well, it's not going to be the same every year. So what do? So if I ask you something like, what is the present value of the interest tax shields? All that you need to do is this. The first thing that you need to determine is what is going to, like if this is my timeline here, all you need to do is first figure out A, how much is going to be my interest expense in year 1? How much is going to be my interest expense in year 2? Whatever that interest expense is, I'm going to multiply that by T to get a sense for how much I'm going to save that in taxes because of that interest expense. And I'm going to do the same over here. And once I have the, right, so this is my tax shield. This is my tax shield and this is my tax shield. To determine the present value, all that I'll have to do then is just discount these back over here. That's the approach. That's the generic approach. That is the exact same approach that we applied previously in the Modigliani-Miller world as well. You will see that this is very, very important. So here's what I'm doing, and I'm just walking you through the approach here. The first thing that I'm doing is that I'm figuring out the payment that I would need to make in order to retire the $1 million loan in 2 years. And I'm using the payment function in Excel. So this is a standard exercise in loan amortization. All that I'm doing is figuring out, like if my interest rate is 8%, and the loan that I want to retire is 1 million, and that's over 2 years, how much is the yearly payment that I need to make? So that comes out to about 560,769. Are you with me so far? When I'll make this first year payment of 560,769, is all of that going to be going towards the principal? No. Loan amortization, as you probably are aware, part of that goes towards the interest. In fact, by the end of 1 year, the interest expense that I will be owing will be 80,000, which will be 8% of the 1 million. So of this 560, 80 will go towards the interest. The rest will go towards retiring the principal. So when you will do the math, you will find that the loan remaining at the end of the first year will be 519. And the reason why that's important is because the interest at the end of year 2, which is 8, is going to be 8% of this guy. So if you do 8%, right? So this for 41,000, if you do this, the guy is basically 8% multiplied by 519,230.77. This is my interest expense for the second year. And so once I have my, so basically what have I accomplished? I've accomplished my interest expense for the first year. That was simple, 80,000. Interest expense for the second year, 41,538. And now all I need to do is multiply these respective amounts by the tax rate, which is given 35%, and then discount these back at my cost of debt of 10%. And this then gives me the present value of the interest tax sheets. I wanted to explain to you the general approach for present value of interest tax sheets. You'll say, why do I need this? You will see. This is going to be very, very important later on, especially when we talk about leverage buyouts. Because in leverage buyouts, as you may recall, what happens in leverage buyouts? These firms take on a whole lot of debt to buy out other firms, and they pay off debt gradually. And part of the way in which they try to create value is through the interest tax shields that they will get on all that debt that they've gotten, right? So we will need to figure out how much extra values will be brought about by all that debt that these leverage buyout firms do. So anyway, that comes later. But this is how you'd go about doing it. Are you comfortable with the general approach? Okay. So we'll get the opportunity to practice this. There is a proof that I want to do, but I don't know if so I'll come to this later. I don't want to scare you off in the middle of the lecture. Maybe some other time. Maybe I'll come to this later. Okay. Let's relax some of the other assumptions of Modigliani-Miller. Modigliani-Miller assumed zero taxes. We said, well, what if taxes are non-zero? So we saw how that changes their propositions. Let's further relax the assumption that there can be something called financial distress. Modigliani-Miller assumed that there is no such thing as financial distress, and therefore there is no cost of financial distress. Now, let's suppose there can be costs of financial distress. What is financial distress? Some of you may raise your hand saying, I'm financially distressed right now. That's not quite what I mean. In the context of a company, or maybe it is, I don't know. What do you think? What comes to your mind when it's financial distress? When we say a firm is in financial distress? Chat.
Just like inability to service like cost of capital payments.
Not necessarily just cost of capital. Not necessarily. But close. Inability to, you can be a little bit more general with that. You can be a little bit more general. It's the firm's inability to meet its obligations. Not just to, basically to all claimants. If you're having difficulty coming up with enough cash to pay salaries, then you're financially distressed, right? It's not your debtors or your equity holders, but you owe some money to your employees, right? Or maybe to your suppliers, right? So in general, when the firm itself or the parties with whom it does business, like its customers, suppliers, employees, lenders, feel that it may not be able to meet all of its financial obligations, that is when you say that the firm is financially distressed. You can think of bankruptcy as an extreme form of financial distress, where you're so financially distressed, you're like, okay, I'm going bankrupt. Shareholders say, hey, debt holders, come in and take whatever you want. We don't want it. So this typically happens when the value of the assets declines below that the debt is owed, right? So this is where in the context of the financial crisis, right, a lot of houses, people like foreclosed on them, saying the value of the house is less than the amount of money that I own this house. Bank, come and get it. I don't want it. I'm going to go sleep in my car, right? So that is basically an extreme form of financial distress. It's one thing that you are having difficulty coming up with the mortgage payments. It's a whole different thing when you're like, okay, it's so extreme that I like take the house I don't want, right? So that's the difference between financial distress and bankruptcy. Bankruptcy you can think of as an extreme form. Okay, so we understand financial distress. Then what are the costs of financial distress? What do you think I mean by costs of financial distress? This is very important for you to understand conceptually. Costs of financial distress. How might, put differently, how might financial distress be costly for a firm? Let's just say, put it that way. Yes.
Reduce your borrowing power.
It will, very good. It can reduce your borrowing power. Absolutely. What else?
I guess going back to like the cost of capital thing, like if everything's a function of risk, then your cost of capital will go up across the board.
And why will cost of capital go up across the board? Why specifically?
Because risk is associated with like operational performance, and so.
So okay. So you're talking about default risk going up in a way, right? So if the firm becomes too indebted, the risk of it defaulting on its debt goes up, and therefore you might say, well, that's going to have an impact on cost of capital. Is that?
Yeah, the same with equity, like same with the other side.
Yes, but you have to be very, very, and this is why I wanted to emphasize this. Default risk going up as a result of more debt is not the same thing as financial distress costs. They're two separate things. In other words, it is possible that your default risk can go up and yet you can have zero financial distress costs. Financial distress costs are a thing of their own in a way. So again, what do you think I mean by financial distress costs? Let's suppose that you are working at a firm, okay, and you find out that the firm has taken on a lot of debt. It's very indebted. And so there is some high default risk associated with its debt. That's one thing. You are concerned that the firm may not be able to meet its debt obligations, and maybe in a couple of months' time, the firm is going to come out and say, Alex, Jonathan, you've been here 2 years, 3 years. Unfortunately, we're in a crunch right now, so we need to let you go. You're expecting this, right? Because the firm is too indebted. If you are one of those employees, what do you think you're going to be doing expecting this when you go to work or in your off time? What do you think you're going to be doing? Sitting in your cubicle, looking on monster.com or, looking at recruiters, looking for a job, right? You're like, man, why am I waiting for them to fire me? Might as well just switch right now. What is that going to do? If every employee is spending 8 hours of their job time looking for jobs, the firm which may not have had a chance of defaulting will now actually default because its employees are less productive. Yes? This is the cost of financial distress. These indirect costs that can occur. This has got nothing to do with the operations or how risky the existing default risk of debt is. This has got to do with how other things can reduce the value of the firm. Like employees start looking for work. Customers may start seeking other vendors. They're like, man, I don't know this 5-year warranty that you're giving me on this car. I don't even know you're going to be around for 5 years. I'm just going to go somewhere else, right? You're too indebted. Suppliers may start demanding cash on delivery. They might say, well, you're too indebted. I don't know whether you're going to have enough money in 6 months' time to pay me. So you know what? I want cash. Lenders may start moving to seize collateral. Key employees may start leaving and start looking for other jobs. And it is these things that can drive the value of the firm down even further. So these actions specifically reduce the value of the firm and may well worsen the firm's predicament. So case in point, you've probably heard about Sears and Sears declaring bankruptcy. All right, so the one article saying that store that changed America declares bankruptcy. What happened, right? So 132-year-old company was struggling for several years. You can read the whole article. It was having difficulty and all, in the wake of Amazon. Most brick and mortar have been. But this was the key. With the writing on the wall that a bankruptcy was imminent, suppliers demanded Sears pay cash up front for the items in its store, putting it at an even greater disadvantage to some of the other retailers. And this is precisely what I mean by costs of financial distress. How financial distress can impose costs like these, further worsening your predicament. Right? It's like this is very important. If two people get together, get married, it's one thing that they're having difficulty with their operations in the sense that they just don't get along. Okay, that's one thing. But now if they go out to parties and they're with friends and they start fighting right there and then, eventually friends like, they're distressed. I don't think I want to be with them. I want to be in my happy place. And then that worsens their situation because of you, my friends don't want to see me anymore, this and that. And that further worsens the predicament. That is the cost of distress. I mean, they were having issues in the first place, but those situations get worsened after a point. See what I'm saying? They're two different things. Two different things. So anyway, cost of financial distress, that's basically what I mean. There are two types of cost of financial distress. There are costs that are direct. So for example, when you will get attorneys involved, auditors involved, and start paying them actual cash out of pocket to maybe, restructure some of the claims, those are considered direct costs. So in bankruptcy proceedings, these tend to be quite high. United Airlines actually ended up paying about $350 million to its lawyers. Enron paid close to $1 billion. Lehman, I think the figure was even higher, close to $2.5 billion. These are, as you can see, this is eating up the size of the pie, right? So these are direct costs, but empirically we find that direct costs are less than 10% of the total cost that firms bear because of financial distress. Most are indirect costs. When customers start to leave, employees start to leave, suppliers get more stringent, these are much more costly than the direct costs. So there's that. So and of course, tarnishing of a company's brand. Now, one way that you can think about these costs of financial distress is this. At any given point in time, you can think of the expected costs of financial distress as a byproduct of two things. A, what is the probability P that the firm will actually become distressed? And second, if it does, what will be the costs associated with that? So P is the probability that the firm will actually become distressed, and cost of financial distress is the actual cost. What do you think? What do you think P depends on? What do you think P depends on? P is the probability that the firm will become financially distressed. What do you think is going to be the one major determinant of P, the likelihood that the firm will become financially distressed? It's quite intuitive. Yes, Benjamin?
The amount of claims that people have to those assets.
Yes, so absolutely, and in fact, in the context of debt, this would be how much debt that the firm has already, right? So if the firm has a lot of debt, exactly right. So P is generally a function of the degree of leverage that the firm already has. In fact, there is empirical research that I wanted to show you some interesting results on. So if you actually take a look at the different types of bonds, like AAA bonds, AA, so basically these are different ratings. We know that these ratings are, to a major extent, a function of how levered the firm already is. So a AAA bond is basically a bond that is very highly rated. This means that the firm either has very low debt or it has very high interest coverage, right? So it has enough, it's making enough money to meet all its claims. So what this research basically shows that if you take a bunch of AAA bonds and look at them over the next 5 years and then over the next 10 years and look at what fraction of those firms actually declared bankruptcy, the likelihood is just 0.03%. Over 5 years and 0.03%, so very practically close to zero over the next 5-10 years. not surprisingly, as you go lower down this food chain, like if you look at the BBB bonds, if you are one of the BBB bonds, the likelihood that you will default over the next 5 years is 2.5%, goes up to almost 5% over the next 10 years, right? So my point is this, these results are consistent with the idea that the likelihood that you will become financially distressed is a function of how indebted you are as captured by these credit ratings. But that just influences P, the likelihood. But how costly will distress be on you? That actually depends on a couple of things. One factor is how much tangible versus intangible assets you have. How do you think that matters? Or let me ask you differently. Would financial distress be more costly for firms which have tangible assets versus those firms which have intangible assets? What do you think? Chad?
Well, if you break the financial distress into like the cost of debt half and then like the, I guess, the perceived risk in the company, then tangible assets would be a much lower probability of financial distress because the cash flows are more certain. Intangible assets, you have like much more like the brand aspect. So the belief is much more significant. So like if people start indirectly perceiving the company as like being at risk of default, it can be much more liable, I guess.
Yes, so again, I would like you to not confuse the likelihood of the firm defaulting versus the cost of defaulting. So I agree with you. If the firm has a lot of tangible assets, then usually tangible assets are easier to value. They're easier to sort of collateralize. Like if you're somebody lending to a firm, if they say, oh, you know, we have this plant and this plant and this plant, you can easily sort of collateralize that, secure that, and say, okay, you know, I can give you debt against that. If you have a lot of like patents or some intangible assets which may or may not have value at some point, then intangible assets generally tend to be less harder to value. In the case of default, you're likely going to have to involve more attorneys, more accountants, more auditors, and just to value those underlying assets. So the cost of financial distress is going to be higher generally if the firm has more intangible assets. The other factor is, you know, if the debt is held publicly versus privately. Think about it. If you're a corporation and if you've borrowed money from two people, okay, privately, as opposed to like 1,000 people publicly, where do you think the cost of financial distress is going to be higher? If distress does occur, if you have just borrowed money from two people, you're like, guys, hey, come on over, I want to talk to you. Sit down in a room, maybe at a Starbucks, have some coffee, say, let's talk about this. I know I owe you money. Let's try to work this out. Presumably easier. Don't have to involve a whole lot of third parties. Probably the discussion can go on. So the fewer people there to tackle, the easier it is. So if the debt is, on the other hand, publicly held by many, many people, then in all likelihood, you know, 5 people will agree, 25 people will not agree. There will be basically a lot more people to work with. And so again, it might be very, very costly. So again, my point was this: you can think of costs of financial distress at any given point as the expected costs of financial distress as a product of what the probability that the firm will become distressed and what are the costs. Probability is a function of how much leverage you have. Cost of financial distress is a function of other variables. At any given point, you can think about what is the present value of all these expected costs of financial distress. And the graph that will, the equation that I'm trying to suggest over here is this. When there are costs of financial distress associated with debt, you can think of the value of the levered firm as not just the value of the levered firm plus the benefit of interest tax shields, but at some point, you have to sort of net out the present value of all the expected costs of financial distress as well. In other words, leverage has a benefit, which is these interest tax shields, but then it also has this cost, which are the expected costs of financial distress. And from a graph standpoint, what we're saying is this: where previously we were just saying, oh, value of the levered firm continuously rises so that it's equal to value of the unlevered firm plus T times B, where this is the present value of the interest tax shields. Now I'm saying that at some point, leverage will become high enough that these expected costs of financial distress will start weighing down on the value of the firm. So that value of the levered firm will not continually rise. After some point, it will start to decline. So notice that when the firm has very little or zero leverage, expected cost of financial distress are practically zero. Right? You're not expecting to become distressed, and I mean the likelihood is just very small. As you take on more and more debt, eventually these expected costs of financial distress will weigh down on the value of the firm. And this, in fact, I mean, an alternative way to express this would be that your weighted average cost of capital, if I had a graph over here which was measuring cost of capital, what I'm saying is that weighted average cost of capital will fall for some time, which is consistent with the value of the firm rising. But beyond some point, these costs of financial distress will start weighing down on you and the WACC will actually start to rise, which is consistent with value of the levered firm falling. Right? So again, two graphs go hand in hand. Okay, this is very important. And this basically then is the starting point of what is referred to as the trade-off theory of capital structure. You may have heard this term before, the trade-off theory. The trade-off theory of capital structure basically says, look, debt is a double-edged sword. On the one hand, it gives you this benefit of interest tax shields. On the other hand, there are distress costs associated with it. It is likely to make you financially distressed. So there is some optimal amount of debt that you should have. So this is the point where the marginal benefit of debt is exactly equal to marginal cost, or basically where the value of the firm is maximized. So the optimal debt is that where the value of the firm is maximized or the weighted average cost of capital is minimized. They're both the same. The static trade, the trade-off theory of capital structure is saying there's a trade-off between the benefit and cost of debt. The optimal amount is where the value of the firm is maximized or where the cost of capital is minimized. Same thing. So that's the trade-off. Does that make sense? There are a couple of other things. So we started with the Modigliani-Miller world. We said, okay, perfect markets, perfect world. Then we said, okay, let's relax the assumption of zero taxes. We saw how that matters. We said, let's relax the assumption of zero financial distress costs. We saw how that mattered. Now we're going to relax one other assumption of Modigliani-Miller. Modigliani-Miller assumed that there are no agency costs. What are agency? Well, now let's relax that assumption. What are agency costs? Very, very, very generically speaking, what are agency costs? You've seen it before. The principal agent problem. Anybody heard that before? Principals or who has not heard of separation of who has not heard of an agency problem or principal agent problem? Okay, that's fine. A principal agent relationship is one in which there is one person who hires another person to do something for him. So if I'm a dad and I hire a nanny to say, please look after my kid, I'm the principal, the nanny is the agent. I, as a principal, want the best care for my kids, but I can't do it myself. I have to go somewhere, so I get the nanny to do it. What's the problem? Nanny doesn't care as much about the baby as I do. Nanny has her own agenda, watching movies, Snapchat, I don't know, whatever, right? So as a result, there is this conflict of interest. Agency problem is this problem of this conflict of interest that exists between what the principal wants and what the agent wants. Agent has his or her own agenda, principal has his or her own agenda. So the principal has to then come up with some sort of a mechanism to ensure that the agent will actually look after, do actually what he or she is supposed to do. So in the context of firms, shareholders are the principal. They hire the manager, say, please go create value for us. But the manager has other interests, private jets, right? So we work, anybody following up, right? The CEO has been let down. He was snorting cocaine in a private jet flying all over the place, right? So, I mean, that's what happens, right? I mean, on the one hand, there is this private shareholders giving money to you, and then you are, you have your own stuff to do. So now you're no longer the CEO. Anyway, this separation of ownership and management, this separation of shareholders and managers, this basically creates this agency problem. And so we know that this exists in public corporations. Right? Managers have their own agenda. In the presence of agency costs, there is another argument to be made in the favor of debt. Take on some debt, because debt will act as like this hanging sword above your head, like, oh, I can make this debt payment. So you are less likely to engage in these extracurricular activities, if you will. Right? So in these firms, debt can act as a disciplinary mechanism. Right? So my point is that taking on some debt might be useful because it can discipline you, especially when there are these agency costs. A manager is less likely to engage in value destroying activities if there is some debt which is acting as a way to discipline him or her. Right? So that is one other advantage of debt. However, beyond a certain point, if you take on too much debt, this is very, very important. Beyond this point, if you take on too much debt, this can actually create a conflict of interest between the shareholders and the debt holders. A new agency problem is born if you take on too much debt. There can be a conflict between what the shareholders want and what the debt holders want. Why do you think that is? What do you think shareholders want? What do you think the debt holders want? If you're somebody who's lent some money to a firm, what is it that you care about? Getting paid back. Yeah, getting paid back, interest, and hopefully the principal amount as well. If you're a shareholder, you are more concerned with the value of the firm going up. Now, in general, the two go hand in hand. But if the firm is too much in debt, the problem is that shareholders have a lower bound on how much they can stand to lose. If the value of the firm goes below a certain point, they'll just declare bankruptcy and like, no, we're done. They have limited liability. So that creates a problem because in certain situations, there can be underinvestment in positive NPV projects. So let me give you an example. So let's suppose, let me see if I can make up this example. Let's suppose that you bought a house for $300,000 in 2007. Okay, maybe make it 400,000. You bought a house for 400,000, and the amount of debt that you took on it was 350,000. So your 550,000 was your equity, and then 350,000 was the amount of debt. Okay. Then came the financial crisis, and the same house that you bought for 400,000, now it's worth maybe 200,000. And let's suppose, for the sake of simplicity, that you still owe close to $350,000. Okay. All right. Now, this is what I'm saying. Let's suppose that in the house you discover that there is a leaky roof. The roof is leaking, and to fix the roof, it's going to cost you $10,000. But if you do fix it, the value of the house, which is currently at 200,000, it is going to go up from 200,000 to maybe 240,000. So it's going to go up. So basically, you're going to spend 10,000 to get a value increase of 40,000. Is it a positive NPV investment? Yeah, sounds like it, right? Spending 10,000 to get 40,000 extra. So basically around 30,000 NPV, positive NPV. Would you do it? Would you do it? You still owe $350,000 in debt to the bank, right? You're like, what incentive do I have to spend 10,000, create this extra value, and then hand off the house to the bank? Because all that extra value that I'm creating, it's just going to go to the bank, right? Because the bank, I owe the bank 350, so everything over here just belongs to the bank. I have no equity, I have negative equity. So what are you going to do? You're like, to help with this place, the bank can fix it itself. Now the bank would love for you to fix it. Bank doesn't want to spend. But there is this conflict of interest between what you want as the owner of the house and what the bank wants as somebody who's lent you money to buy the house. There's a conflict of interest between the equity holder and the debt holder. When you become too indebted, as a shareholder, you have an incentive to underinvest in positive NPV projects. Why? Because most of that positive NPV is going to end up going to the debt holder, and you're like, why should I care then, right? So this is an important terminology for you to remember. This is a manifestation of something called a debt overhang. A debt overhang is a general situation where you are so indebted that even if there are some like positive NPV projects for you to take, nobody is willing to give you the money because like, why should we give you the money to invest in this positive NPV project so that you can create all this positive NPV and then hand it over to someone else who already has claim on this sort of firm before us. And I don't know if you've been following on WeWork, but WeWork is actually having the exact same problem. WeWork was banking on the fact that they will get all this money through their IPO. And now that they don't have this IPO going, now they're trying to raise more debt to pay off some of the existing debt that they have. And as a result, their bonds are trading at a very high yield. The prices have like plummeted on their bonds, right? For that exact same reason. So anyway, this is a debt overhang issue. The other issue with taking on too much debt is this. Not only are you going to underinvest in positive NPV project as a shareholder, but you might be inclined to overinvest in risky projects. Think about it. You're the manager at firm XYZ. You've got $10,000 lying in front of you. You're like, okay, I owe the bank $20,000. You know what? I mean, I can see this is not going anywhere. Bankruptcy is likely what I'm going to have to do tomorrow. But hey, like there's still 12 hours till tomorrow, and Atlantic City is close by. Let me just try my luck. Let's see what happens, right? I mean, what's the worst that can happen? I'm going to declare bankruptcy anyway. It's just going to be $10,000 less to pay those guys. Why do I care, right? And so you're likely to overinvest in risky projects. Now, if the bank finds out, bank would likely call you and say, please don't go. Like, don't squander away the 10,000 at least that we can get from you. But you as a shareholder, like, what the hell? My downside is limited, but my upside is potentially huge. So, roulette, here I come. So all of this can be problematic. My point is this, that in the presence of agency costs, you can think of the value of the levered firm as the value of the unlevered firm. Debt has this benefit that it can give you these interest actions. So debt creates some value, but then it can also take away some value because of expected cost of financial distress. Then on the plus side, there can be some value from debt because it can act as a disciplinary mechanism, right? So this is some added value that debt can bring. But then there can be extra cost as well because that same debt can create this conflict between the shareholders and the debtors, which can reduce firm value. So main point is that there are some benefits to debt, like interest tax shields, disciplinary power, but costs like financial distress costs and costs associated with this conflict of interest between shareholders and debt holders. Again, the main idea is that in this graph, you can think of this optimal point over here as being the point where the benefits, the extra benefit is exactly equal to the extra cost. So here you can think of the difference between these two lines as the net present value of financial distress costs, including agency costs. Main point, there are some benefits, there are some costs. At some point, there is this optimal. So that's the trade-off theory. There is one other theory that I wanted to talk to you about, which is the pecking order theory, but I think maybe I'll talk to you about that when you actually discuss the case, which is next Tuesday. But here's the implication from trade-off theory of capital structure. First, it is better to have some debt rather than none. Why? Because as you can see, for very low levels of debt, this is very important. For very low levels of debt, you're unlikely to have any of the costs. Distress is going to be unlikely, so this is going to be zero. And the likelihood that you will have any conflict between debtors and shareholders will be, like, these costs will be low. So trade-off theory sort of suggests that you should have at least some debt because you can get these interest tax shields. But actually, if we actually go into the real world, while we find that some implications from the trade-off theory are consistent with what we find in the real world, like in the real world, we do find that firms target certain leverage ratios or certain interest coverage ratios, which is consistent with this idea that firms are targeting some optimal. We also find some firms which don't like debt at all. They avoid debt altogether. And that is very hard to reconcile with trade-off theory, because trade-off theory says, wait, you don't want the interest tax shields? Right? I mean, why have zero debt altogether? So it turns out the pecking order theory of capital structure is something that sheds light on that. And in fact, you'll get an opportunity to sort of think about that once you do the California Pizza Kitchen case. Okay? So that's all for today. Thank you. And if you have any questions, please let me know. We'll have the California Pizza Kitchen case presentation and case analysis for next week.